Hello, retirees or aspiring retirees. Welcome to my page, Retirement Guru. The topic for today is my retirement investment strategy. But before I begin, I need to do some formalities. So allow me to read to you this disclaimer. First of all, the information I'm sharing with you is for informational purposes only. The information does not and should not be considered to constitute an offer to buy or sell any securities, and this information should not be relied upon to make any investment decisions. Remember, I'm not a financial consultant and I'm therefore unable to give you financial advice. What I'm doing today is sharing with you my personal strategy for you to consider as an option. And if you think it's something you want to consider, please do your research and consult a professional on how you should do it. Before we move on, I'll allow me to share with you two fundamental rules that I keep in mind whenever I'm trading. Number one, I trade only the cash I have or the assets I own. I do not use margins. The strategy I'm about to share with you involves margin trading, and margin trading comes with it the option to use margin, which means to borrow money that you do not have to make trades. And to me, that is where the danger comes, because when you trade with things or money you do not have or you do not own, that makes the danger, that extrapolates the danger and makes it very dangerous for you. So as long as you trade with cash you have or assets you own, you minimize the danger, right? You contain the losses to that, to whatever you have. And I want you to remember that small wins add up. I know many friends or many people always aspire for big wins, right? It feels great to so-called trade and make $100 or $1,000. But if you make win $20, $30 each trade, to me, 10 trades can be equivalent to as much as one big trade. So always remember small wins add up. So please do not pursue the big ones, because the bigger the trade, right, the bigger the win, of course, it comes the bigger the losses. Okay, moving on. For those who have actually been following my page, my YouTube channel, you know that I'm actually a big advocate for retirement or for dividend investing. Why I believe dividend investing is important? Because it is a very ideal source of retirement income. Right? If you have this nest egg that pays you money every month, when you retire, you don't have to do much, just to have to monitor and maintain it, monitor it and make sure it's doing well. You continue to get income every month. And the beauty of dividend income is that if you start young, each time or each month you get dividends, you buy more dividend shares and it continues to grow. Eventually, after a while, you have a huge snowball of dividends paying you significant returns. So for me, I've been doing dividend investing for the past 3 years, and I do believe that I'm relatively successful and I'm having good income from it. Now, what what is pushing me to actually consider other options? Well, as I look at it, I believe in maximizing our income. So if I continue to so-called rely on reinvesting my dividends and buying more and more dividend shares, that is one viable option. However, I believe there are also other options for me to so-called increase my income by trading options. So I actually have embarked on a strategy where I use two different option strategies to supplement my current dividend income strategy. The first one I use is what I call, or what is called, selling cash secured puts. Okay, I will not go into detail about what options are. If you're interested, you can actually go and watch many other YouTube videos. The purpose of this video is to share with you the strategy I use so that you can consider adding this to your strategy to boost your income. So with my dividend income, the first way or additional strategy I use to boost my income is to do what I call selling cash secured puts. Selling a cash secured puts means I promise to buy a particular share at a particular price down the road. I'm giving the buyer an option when I sell this option. So what do I get in return? The buyer will pay me a premium for this option to buy the share at a higher price. On the other end, I actually sell covered calls. Covered calls means I have these particular shares, these dividend shares, and I'm actually offering to sell my shares at a particular price, right? And in return for the option to buy my shares at a particular price, the buyer pays me a premium. So what works is that while I'm earning my income from my dividends, I also use these two other strategies to actually increase my earnings by earning for more premiums. Okay, so look at this diagram here. right? On the right side, the dividends. If I have the dividends, I'm paid a dividend. I use the dividends to sell cash secured puts. What is a cash secured put? A cash secured put means I have the money, right? I say I'll buy it, but I have the money sitting there in my account waiting to buy the shares if the option expires in the money, right? Once again, please go and watch other YouTube channels to understand what I mean. But if I use this strategy, if it expires in the money, I have the money to buy, and it doesn't cost me, it's not risky to me at all. So what happens is that when I sell these cash secured puts, I receive a particular premium, and I get a premium immediately. This premium I can then put back into the pool, and I can use that to buy other shares. And the beauty about this is that as my money sits in this pool waiting for the options to expire, I'm actually earning interest. So I'm actually maximizing my income. Right? What I have, I sell premiums and I collect interest. So what happens if the option expires in the money? Well, if it expires in the money, then I actually end up buying the share and it goes back to my dividend pool. And next month, I collect more dividends, which I can then use to buy or sell more cash secured puts. Not bad, right? Okay. Now, what about on the other end? So now if I have all these so-called dividends, what can I do? Right? I have all these shares sitting there. I can, of course, sit there and wait and collect dividends, or I can actually make it work harder for me. So what I do is that I then sell covered calls. Selling covered call means I promise to sell a share at a particular price, right? And in return for the option to buy my shares at this particular price, the buyer pays me a premium. So similar to selling cash secured puts, I collect a premium, right? And I can then use this premium immediately to plow back into the pool of money, which I can then use to either sell more cash secured puts or wait and collect interest. So what happens if when I sell my covered call, the options expires in the money? It means I have to sell. I have to sell the shares and I collect the money. And the money that I collect from the sale of these shares goes back into the pool where I can then sell more cash secured puts. But if it expires out of the money, what happens then? I then keep the money, keep the premium, and I can then sell more covered calls. You see, I then actually earn on both sides. Now, this diagram seems a bit complicated, but it essentially sums up what I'm doing. I have the dividends there, I sell cash secured puts, I actually sell cash covered calls, and the many ways in which the money works harder for me is shown on this diagram. Maybe I'll then show you an example that actually happened for me 2 weeks ago. 2 weeks ago, I received some dividends, about $1,000 in dividends, and I was actually thinking of instead of buying directly, let me use this strategy. So what I did was I was looking at TSLY. TSLY was trading at a price of $9.55. So I could have bought the share at $9.55, right? And that would be the end of it. But then that would have maximized my money. So what I did was I actually sold a cash secured put for $10, right? That means I'm telling the buyer at this point of time, I will buy your share at $10. In exchange, the buyer paid me a premium of $1 per share, which means I collected $100 upfront. My option, of course, I hope, was that the options will expire out of the money, that I just keep the shares, right? I keep the premium, and I can then sell more cash secured puts. But what happened? TSLY closed or option traded and closed at 9.24. Right, that was actually below the $10 strike price. So I was actually forced to actually buy the particular shares. But remember, I bought the TSLY at $10. I collected $1 in premium. So my effective price for buying TSLY was actually $9. But because TLSY closed at 9.24, when I was assigned the shares, I immediately made a profit of $24. Right? Not bad, right? So the $24 was mine. So what did I do now? With 100 TSLY shares in hand, I then went to the other side of the chain and I went to sell a covered call. I immediately went to ask for a covered call and I sold it at a strike price of $10. In exchange, I received $10 in premium. So what did I earn? I earned the $24 plus the $10 immediately, right? So that's $34. Now what will happen now? If TSLY closes in the money, meaning that it sells at $10, it strikes at $10, and the person buys my share, I immediately earn additional $76. If it closes out of the money, I keep the $10 in my pocket. Right. So from this simple example, if you can see on screen, right, I also made, I would say, pretty good money. Not forgetting that while I hold on to TSLY, TSLY will pay a dividend next month, and because the option expires after the dividend ex-dividend date, I get to keep the premium. Last month, TSLY paid a premium of 53 cents per share, so 100 shares that will give me $53. So if you look from this simple, these two trades that I made, right? If, for example, the TSLY that I so-called a cover call on now expires out of money, I will have made a total of $87, $34 from the premium, and another $53 from the dividends I will collect. But if TSLY expires in the money, meaning I have to sell my shares, I'll make a total of $163, meaning $110 from the trade and another $53 from the premium I collect. So as you can see from this example, I've actually used selling cash secured puts and cover calls to maximize my return. If I had merely purchased 100 TSLY shares, I would have likely only earned $53 in dividends. But this way, I've actually increased my earnings and actually made my money work harder for me. Okay, so once again, this is a strategy I use to actually increase my dividend income. It's a viable strategy, but I want to remind you of the simple rule or the important rule to only trade with money you have or shares you have, and do not use margins. And for a final reminder, do remember that I'm not a financial consultant, and whatever I'm sharing with you is my personal strategy. If you think it will work for you, please go and research more. If you think you want to then subsequently take the step and follow me, please consult a professional before you do.